numbers, but growth for the next fiscal as well.
Okay. Well, actually, the capital goods number Anuj calculates is come in at an index number of 542 compared to 593 in January and 649 in December. So for 3 straight months, you're getting a huge fall in the capital goods index itself, as you point out, Sajid. That is a lumpy number, and that is worrisome because we don't even have anecdotal evidence of huge investments being made except in infrastructure. Now the index Sensex is down 117. The Nifty is getting closer to the 5,800 mark, and I think the capital goods index would be singly responsible for this big fall. Pull up the capital goods index as well for you.
Yes, indeed, and Siemens is one stock which is down about 4% or so. Apart from that, the market itself, if you see, it's now trading at day's low, 125 point lower, and quite clearly it's now really the growth fear which is now trickling in. Siddharth, what's your sense? Now RBI would be in a bit of a quandary. We've seen different views so far. One view is that RBI will still have to go ahead and hike rates by 75 basis points. If we continue to get these IIP numbers for say maybe next couple of months, would that change the situation a little bit?
I think, Anuj, it's a reality that we'll be getting IIP numbers in similar range, and at the same time it's a reality also that RBI will keep on hiking. We are factoring in a 25 basis point hike in the May policy. We don't think RBI will ever do a 50 basis point kind of a move unless situation go out of hand completely. We are factoring in 50 basis points hike from here on. Basically what's happening typically in case of India, whenever you see some kind of industrial slowdown with some kind of lead lag impact, you see some kind of softening in prices, but that kind of correlation is completely breaking down in the current cycle, and you don't really expect that to the IIP numbers to have some kind of favorable impact on inflation anytime soon. The second round impact of some of the items like rubber prices, cotton prices, all these things are yet to really kick in. So upside surprise in inflation is still very much there. We are factoring in a number of around 8.4% for March. Now you have to see that it's a significantly higher number compared to what RBI had been projecting 3 months back, and even a month back when they had said 8%, and missing that 8% even, that will be quite a difficult spot for RBI. The priority on their part is clearly to tackle inflation at this moment. Growth is a priority, but a very distant second priority.
Oh yes, and growth is not really wobbly if you're doing it at 8.6, but inflation is genuinely becoming too hot to handle. Suyash Chaudhary is with us. Suyash, before I come to you, one more word from the economist on where they see inflation coming in, and I'm coming to you to what you expect in terms of rates and yields. Sajid, the IIP number is here, come and gone, and we are probably going to see also a similar performance in March. So we will probably we are going to see a 7.8% industrial growth for the current year and an 8.6 GDP growth. Growth weak, but not really terribly. Growth weaker than perhaps 2010, but clearly not weak per se. Inflation, what is your forecast? Not just for March, but even beyond. In March, we have the coal prices getting factored in completely. In perhaps May, we are definitely going to stare into a fuel price hike as well. What's your inflation forecast for the first half of FY12 as well?
Yeah. Lata, it's quite sobering. Last time we spoke, we mentioned that we think inflation remains very high and very sticky for the first 7-8 months of this year. We think March ends up around 8.4 or 8.5 even, and the fact is that it's now settled into this range. I mean, January, February, March, all in the 8.3, 8.4 range. Remember, these are unrevised numbers. When the December number got revised up, it was revised up to 9.5. So inflation is now tracking close to double digits. The central bank has revised its forecast by 250 basis points in the last 2 meetings, and even that new forecast of 8% will be breached. So clearly inflation is going to be high and sticky. Core inflation has picked up. We knew that non-food manufacturing surged last month and will likely stay very sticky for much of this year. We think inflation peaks around the 10% mark in July, August, and then comes down only contingent on a credible fiscal consolidation. Remember, net of asset sales, what the government's planning in the budget is a very sharp fiscal consolidation, almost 1.5% of GDP. If you even get a 1% of GDP fiscal consolidation, that will slow the economy and help moderate core inflation. I think that's the only series of situations or circumstances in which inflation tapers off in the second half of this year. The RBI will have to raise rates at least 2 or 3 more times in this calendar year.
Okay, Well, now to where the bond yields are headed. Suyash is waiting by. Suyash, thanks for waiting by patiently. Do you think bond prices are unrealistically high now? Just about everything seems to be going against it. We are definitely going to have a fiscal deficit that will be different from what the government forecast, much higher, given the kind of fuel prices at this point in time at least. And inflation, I mean, as Sajid was pointing out, even from the Jan forecast of RBI, we are 150 basis points higher. Jan, the forecast was 7%, they upped it to 8% only in February, and we are going to end at 8.5%, and we have not yet had a fuel price hike, and we are going to see perhaps new highs even in metal prices and other commodities. What is the expectation in terms of the yield curve, the 10-year? I don't know if we have the 8.08, the 7.80 2020. We are yet to get that graph in, but what do you expect the yields will go to by say May or June?
No, absolutely, Lata. To begin with, I mean, taken in context the Friday's auction, we have started off relatively bullishly. And some sort of bullishness with respect to a new benchmark was expected, but we seem to have kind of overstretched ourselves given the fact that we are just starting the new fiscal supply. So from that perspective, we do think even the new 10-year has to consolidate higher than 8% as more and more supply hits in. With respect to inflation per se, I mean, the trend we are really concerned about is that the core aspect of inflation is picking up. And if you extrapolate the slowdown in capital goods, whatever it's worth, owing to the fact that it's coming from a high base as well. But broadly, if you look at, for instance, investment to GDP within the economy, it doesn't seem to be supporting a slowdown in core inflation. So the mix of inflation is what is bothersome. But on with respect to RBI policy, I mean, one of the things from the bond market's perspective one must take into account is that if you were to look at 1-year CD rate still, they have close to a 300 basis point spread over the RBI policy rate. So the uncertainty with respect to liquidity combined with RBI policy is still ensuring a huge amount of transmission. So from that perspective, we would still expect a 50 to 75 basis point hike, but we don't expect a panic reaction, so to speak, from the Reserve Bank of India.
No, 50 to 75, yes, I agree. CP rates are reflecting, but what do you expect the 10-year might print by, say, May or June?
Broadly speaking, we would look at a range of around 8.15 to quarter, maybe 8 quarter is where it would settle or closer to that. Triggers for us really would be, rather what we are looking out for this year as well is how will the Reserve Bank of India ensure liquidity creation in the system. And today, I mean, you are seeing the best part of liquidity with the system roughly balanced now. But as you head into the next 6 months, the usual problems that you faced last year, specifically a huge rise in currency with public owing also to the fact that you have state elections this year. So really what we are looking for is how does liquidity get created, or more specifically how does high powered money or primary liquidity get created this year. And if the answer again is open market operations later in the year, then you may still seek an entry point at around 8.20 quarter on the 10-year.
Okay, well I